Let's go ahead and run through an example of the equity method where the subsidiary is acquired at more than book value. Now, it's important that before we start working on consolidations of subsidiaries acquired at more than book value, that we're all comfortable with accounting for such investments under the equity method. Now, back in lesson 2, we covered the equity method to an extent, but we didn't do it in a lot of depth, and it would be helpful if we looked at it a little bit more closely now. So let's go ahead and run through an example. Let's assume that on January 1st, 2001, Big Company acquired 100% of the voting stock of Little Company for $400,000. On that date, Little Company had owner's equity of $300,000, $100,000 of common stock plus $200,000 of retained earnings, and Little's assets and liabilities had fair values equal to book value, except first they had some inventory accounted for on a FIFO basis, which was undervalued by $20,000. They had some patents with a 5-year life undervalued by $60,000, and they had some land overvalued by $30,000. Now, the first thing we have to do is to perform what's referred to as the differential analysis. Again, the cost versus the fair versus the book value. The cost of $400,000, the book value of $300,000. There's a $100,000 premium that was paid, and that's referred to as the differential. And we have to explain why does that premium, why does that differential exist? So we're going to go ahead and spell out exactly how the subsidiary's assets and or liabilities are misvalued, and after that to determine the amount of goodwill or bargain purchase inherent in the purchase. Now, in performing this analysis, it can get confusing knowing how to handle overvalued versus undervalued assets and overvalued versus undervalued liabilities. Most textbooks don't stray far from having only undervalued assets, and that's not terribly realistic. You can have both undervalued and overvalued assets, and you can have misvalued liabilities as well. So we really do need to be able to cope with more complex cases. So let's go ahead and see. When do we subtract and when do we add these misvaluations? The most intuitively simple case to start with is that of undervalued assets. If the subsidiary has undervalued assets, that means the assets are worth more than book value, and it explains why we paid more than book value. So undervalued assets explain away part of, or perhaps all, of the premium, of the differential that we paid. So since those undervalued assets explain away part of that differential, we subtract that amount from the differential we're trying to account for. So undervalued assets, we subtract. Now, if we subtract an undervalued asset, that implies that we should add an overvalued asset, because subtract versus add, undervalued versus overvalued. So overvalued assets, we're going to go ahead and add those in. Now, assets and liabilities are, in a sense, they're opposites. Certainly from a debit-credit perspective, they're opposite. So they're going to behave in the opposite manner. Undervalued assets, we subtract. Undervalued liabilities, we add. And then finally, if we add an undervalued liability, then we must subtract an overvalued liability. So again, the way I approach this is I start with the intuitively rather obvious case of how we deal with undervalued assets, and then use that as the stepping stone to remind myself how these other cases are dealt with. So just to recap the differences we had between fair value and book value, we had inventory on a FIFO basis undervalued by $20,000, patents undervalued by $60,000, land overvalued by $30,000. So let's go ahead and run through this analysis. First, we start with the cost versus the book value. Again, we paid $400,000 for an investment with a book value of $300,000, so we paid a premium or a differential of $100,000. And then we say, okay, of that $100,000, $20,000 of that was explained away by this undervalued inventory. Again, inventory is worth more than book value, so we paid more than book value. So that explains away part of that $100,000 differential. Likewise, the undervalued patents explain away even more of that, so we subtract $60,000. And then lastly, the land, again, that was overvalued, so we add that instead of subtracting it. So those were our three misvalued assets, And whatever's left, if it's positive, it's goodwill. That means that there's some premium that we didn't explain. It must be attributable to something. If it's negative, then we're going to go ahead and call that a bargain purchase. So in this case, we have $60,000 of goodwill. Now, the differential assigned to or associated with the finite-lived items, the inventory and the patents, will need to be written off as those assets are consumed. Again, inventory, we always assume a FIFO basis for inventory. That way it's always sold the very first year of ownership. And the patents over 5 years, those things will cease to exist after 5 years. And so they need to be written off. Now, we can think of this amortization process either from a balance sheet perspective or from an income statement perspective, whichever way is easier for you to understand. Let's go ahead and start by considering the inventory, again, under a FIFO basis, undervalued by $20,000. From the balance sheet interpretation, we'd say, okay, our investment in little account includes $20,000 that we paid for this extra inventory value. Under a FIFO inventory basis, by the end of the first year of ownership, that inventory has been sold. It no longer exists. So since that inventory no longer exists, that $20,000 premium in the investment in little account should no longer exist either. So we're going to go ahead and credit the investment in little for the amortization. The income statement perspective, we say, well, look, when Little computed their income this year, they're going to calculate cost of goods sold and therefore income based on the historical cost of their inventory. And from Big's perspective, that inventory value is too low. As far as Big is concerned, Little's inventory was understated by $20,000, which means Little's cost of goods sold was understated by $20,000, which means Little's income was overstated by $20,000. Now, under the equity method, Big reports their share, in this case 100%, of Little Company's income as investment income. So since Little's income was overstated, Big's investment income was overstated. So we need to go ahead and correct that by reducing investment income by $20,000. And let's go into the same sort of analysis with the patents. Again, 5-year life, undervalued by $60,000. So that $60,000 is going to be consumed or written off over 5 years. $60,000 divided by 5, $12,000 per year. And again, we can either view that from a balance sheet perspective or from an income statement perspective. The balance sheet perspective, we say, okay, $60,000 of our investment in little account is associated with an asset which is disappearing over 5 years. As that asset loses value or loses accounting value, so does our investment in little account have to drop as well. So we reduce the investment in little with a credit. Income statement perspective, again, from Big's perspective, Little is underreporting their patent, therefore they're underreporting their amortization expense, therefore they are overreporting their income. If Little overreports their income, Big in turn overstates their investment income. And so to correct that, we're going to go ahead and reduce investment income by $12,000 per year. Now, in subsequent years, we wrote off that entire $20,000 differential associated with inventory in the first year. It's never to be seen again. It's been sold. It's been recorded as cost of goods sold, and it's out of our lives. The $60,000 differential associated with a patent is going to be around for 5 years. We're going to write it off at $12,000 per year for 5 years. Now let's go ahead and just go through the entire equity method cycle. We're going to have this recurring mantra: income, dividends, amortization. Income, dividends, amortization. So let's go ahead and assume that Little reports earnings of $100,000 and pays dividends of $10,000. And again, Big is the 100% shareholder of Little. So income. Big reports their share of Little's income as investment income, $100,000. Dividends. Little pays dividends of $10,000. Big receives all of that, so Big debits cash for $10,000 and reduces their investment in Little by $10,000. And then amortization. And again, we've got two aspects of amortization here. We have our amortization of the inventory differential, again, that $20,000 Inventory differential is being written off all in one fell swoop. And we have the $12,000 amortization for the patent differential. Now, one thing that can get confusing, for the inventory differential. When we think about that, we're thinking in terms of, okay, that's inventory, and as that gets amortized, basically this is an adjustment to cost of goods sold. That excess inventory value should be reflected in cost of goods sold. Under the equity method, the adjustment is always to the investment income and the investment little. Over on the consolidation worksheet, that's where we're actually going to record the increase or decrease in inventory, as the case may be. And when we amortize, we're actually going to adjust cost of goods sold. So we've got two sets of entries sort of going in parallel. On the parent's books, on Big's books, when they do this amortization, it's always the investment income and the investment in little. There's no mention that this is due to inventory, or this is due to patent differential, or this is due to any other sort of underlying asset or liability. It's simply an adjustment to investment income and investment in little. For the consolidation process on the worksheet, that's where we're actually adjusting the underlying assets and adjusting the underlying expenses, i.e. cost of goods sold or amortization expense.